This is Trend Following Radio, where great thinking comes alive. Nobel Prize winners, legendary traders, best-selling authors, and the pros that know what drive us irrational human beings. I am your host, Michael Covel. Not filtered, raw, honest. That's my passion. So today on the show, I have Scott Patterson, and Scott's going to bring a really different perspective to my show because I think what Scott's really done a lot of homework, a lot of research on is the subterranean bowels of markets and quite a bit of experience. His prior book was called Quants, Wall Street Journal reporter, has written for Rolling Stone. His newest book, something I really want to get into because frankly, I'm probably like a lot of people out there. I just don't, even though I write about Wall Street and finance, I don't follow this subject. But his new book is called Dark Pools, High-Speed Traders, AI Bandits, and the Threat to the Global Financial System, which is fairly daunting and scary sounding, Scott.
Yeah. Well, you know, I started looking into this stuff a couple years ago when I was a reporter at the Wall Street Journal, and high frequency trading, which is something I really look at a lot in this book, was becoming really, a hot topic. And at first I thought, this what's wrong with this? Because there were some critics, and it seemed, like it was helping the market. And I really didn't think that there was much wrong with what was going on. But the more I learned and the more I actually learned about how this stuff worked and what was going on across the market and at the exchanges and at the dark pools, I got more and more worried. And then as I started working on this book, it just got it really started to open my eyes and realize that we have a major problem on our hands. And also, when I was at the Journal before, I left for a while to write this book. I covered the flash crash for the Journal, and that was a landmark event in the recent history of our markets. And it just scared the bejesus out of everybody because it was sort of like a warning sign of what could happen.
Yeah, but before you get there, I want to go back in time because I think we need to set some foundation here. Mm-hmm. So we have a nice long form podcast here where you can really explain some things. And I think it'll help to give some context, even for me too, to go back in time. And I think when we start to talk about this, the high speed trading and the electronic communication networks, the ECNs, where is the starting point? I mean, I have a feeling you're going to say it kind of starts with a guy named Joshua Levine, or Levine. How do you say it?
Yeah. Josh Levine is this, totally fascinating character that I discovered in my research, who I would say is probably the most important figure in the history of modern day markets that people have never heard of. But it actually, Josh's story starts in the 80s when he was a 17-year-old college dropout, worked in the streets of Wall Street as a computer programmer, selling his trading systems to giant hedge funds and even firms that traded on the New York Stock Exchange and big market makers. So he was right there at the beginning when computers started moving in to the trading floor. And then in the early 90s, he hooked up with this group of sort of renegade day traders at a firm called Daytech. Daytech was, basically a bunch of guys who had been market makers, but they figured out that they could make a lot more money by trading on this very new sort of incipient computer trading system on NASDAQ called the Small Order Execution System. Shorthand is SOES, and they eventually came to be known as the SOES Bandits. So Josh, this young, sort of bright-eyed, idealistic computer programmer, teamed up with these guys from the streets of Brooklyn and the Bronx, these day traders, rough and tumble crowd, and together they launched a revolution in computer trading. And it's just a completely amazing story. They did it all out of this office on 50 Broad Street, just like about a minute or two walk from the New York Stock Exchange. And Josh slowly put together this computer system that became a powerhouse.
I was going to say, what was he, before we get to the powerhouse part, what was he doing at the very beginning? Like, for example, with Island, what was going on so the average person can understand this in the context?
Yeah, well, you mean before he got to Island?
Yeah, well, yeah, or even around that time. You could pick it up around that time.
Yeah. So, well, basically, these guys were trading on NASDAQ on this SO system, and they really hated how crappy NASDAQ was. And a lot of the market makers really didn't like what they were doing, so they were getting a lot of noise. So, it's just like any day trader. I mean, this is back when day trading was getting bigger and bigger. You buy a stock, you're a trend follower, essentially. You wait for it to go up, and then you sell it fast. Or you short it and you wait for it to go down and you sell it fast. They wanted to do that without the interference of the NASDAQ market makers. And give
people an example of the kind of interference you're talking about that NASDAQ was doing that they wanted to get around.
Right. So they would send an order to a NASDAQ market maker, and a lot of times it was on this automated system, but they didn't always go that way. They went through another system that NASDAQ had that required the intervention of a human market maker to make the order work, to make the market, essentially. Because the NASDAQ market makers hated Daytech and they hated what they were doing, they would just not recognize the order. They would do what is called backing away. They would just say, well, that order's been filled already, and they would just reject it. And at Daytech, that was just infuriating because, these were legitimate orders. So out of that frustration that Levine had and the Daytech traders had, they decided to create a method where their orders could interact with one another, so where they could bypass NASDAQ and do it all in a automated way on a computer system. So Levine started putting together this system, and slowly it evolved into a computer program that he called Island. And Island he called it that because it was sort of like a refuge from the NASDAQ cesspool that they hated so much. So in 1996, in January 1996, that's when he first launched Island. And it slowly got bigger and bigger, and more outside firms started hooking up to it. And by the late 90s, Island itself, with the help of some regulatory changes that have been passed by the SEC, which totally, clamped down on a lot of the nonsense that was going on at NASDAQ, Island was accounting for about 10% of all trading of NASDAQ stocks. And it was just a huge revolution because these guys just came out of nowhere. And it is, in a way, a perfect example of how technology is the perfect medium of creative destruction in an economy. Because what Island was doing was totally destroying the old guard, and
they were eliminating the middle. The middleman was getting quashed right out of there.
Yeah,
right?
Because it was all automated by a computer. So those guys that were sitting there on their NASDAQ market making systems, putting together orders for clients, using point and click on their computer screens, were being phased out. They were going the way of the dinosaurs. So, Island got bigger and bigger. And then the big change that happened that, we can look at today what our markets have become and see the germ of it right there on 50 Broad Street at Island was a new breed of computer trading operation rose up. Started with a couple firms called GetGo and TradeBot. And today, these are two of the biggest high-frequency firms in the world. They showed up at 50 Broad Street and said, we want to use your system because it's faster than anything else we've seen. And it's totally scalable. And they could, put as many orders as they wanted into it because the Island system that Josh had programmed was so robust. So in the early 2000s, these high-frequency traders all started using Island, and they got bigger and bigger, and Island got bigger and bigger. And it was something that was going on that I found talking to people at the New York Stock Exchange and NASDAQ had no idea that this was happening.
Scott, to interrupt though,
Yep, sure.
the HFT traders at this point in time, these are basically just funds. These are no longer market makers. These are guys saying, hey, we can use Island to profit by buy and sell decisions at a kind of very short time frame intervals, right?
Right. Yeah, they were buying and selling stocks. I mean, back, compared to what now is a fast time, like, it took forever, but they were buying and selling stocks in a minute, say. Using a very new style of trading, and actually, what I found is it's actually kind of an old style, just used in a new way, called scalping, basically. And that's kind of like what market makers is you buy low and you sell high, and you do it very fast. And it's kind of like how a market maker works, and they could do it in an automated way and do it very rapidly.
So what you're at that point now where it's like, okay, Levine establishes Island. Everyone says, "Wow, this is a great robust market for us to apply automated technologies to." And a couple of these HFT players come in and say, "Great." Pick it up from there. What starts to happen now in the early 2000s due to this novel kind of connection of these two groups?
Right. So NASDAQ starts noticing that a large portion of trading in their own stocks is happening at these places that they had totally been disregarding. And they had no idea what was going on. They had no idea why. I mean, of course, they knew about Island, but they had sort of discounted it as just being this, group of eggheads over there on 50 Broad. But what was happening was the entire market was being changed, and they didn't know it. They didn't know why, and they didn't know who these people were. I talked to a guy who'd worked at NASDAQ, and he said, we saw all this volume taking place in our stocks at these firms that were out in the Midwest that we've never heard of. They called up those firms, GetGo and TradeBot, and said, why don't you guys come over here and trade with us? And they didn't want any part of it because NASDAQ was still clinging to the old system of human market makers being involved. That's what they were, and they refused to let go of it. And forget the New York Stock Exchange, because the New York Stock Exchange was just, their technology was ancient compared to what NASDAQ had, and they were relying on their specialist. So it was the revolution happening. The big exchanges had no idea what was going on. They were completely out of the loop, and Island got bigger and bigger. And then in 2002, Island merged with a firm called Instinet, which at the time was one of the biggest traders of NASDAQ stocks. Together, Island and Instinet accounted for about a quarter of all trading of NASDAQ stocks. So you had, by then, a real powerful competitor.
Hey, Scott, let me ask, how did we get to the point that Island even came to exist? I would have thought that the New York Stock Exchange, NASDAQ, et cetera, with boatloads of lobbyists and political connections, never would have let somebody come in and eat their lunch, so to speak.
Well, I think it's, the march of technology can't be stopped by lobbyists. They tried. I don't think there's any question that they tried. I mean, there was all sorts of roadblocks put up in front of Island, and they just stepped right over them because there was, it was a complete transformation of how the market worked. And I don't even think that NASDAQ and the New York Stock Exchange knew what was going on. I don't think they knew what to lobby against. And by the time that they figured it out, it was too late. The system had been changed. The high-frequency guys were getting bigger and bigger. And some other changes happened in the early 2000s, too, that marginalized the market makers. Like decimalization was a huge game changer. Right. That caused spreads to narrow dramatically, and the market makers' margins just evaporated. But that trading in penny increments was something that was perfect for the high-frequency guys. They loved it because their computers could handle all of those various price points. Whereas for a human, a guy sitting there at a screen trying to figure out, all these different decimals and what's the best price to bid and, sell for, it was just way too confusing. So, a lot of things changed.
So as you get to Instinet and Island combining forces, and I want you to continue your story from there, but are we still too early to introduce the title of your newest book, Dark Pools?
No, this is around the time when the dark pools started popping up in the early 2000s.
You're going to have to you got to walk us through that, because I want people to understand this, because I think this is a phrase. It's a great title for a book as long as you understand the context of what it means.
Right. Yeah. Well, I mean, my context is a little different from what people would think, but I'll first explain what a dark pool is, the technical definition of a dark pool. It's an alternative trading system that is set up away from the public markets. So, the public markets are the so-called lit exchanges, where the prices are published. They're there for everybody to see, and it's all out there in the open. A dark pool is dark. The bids and the offers are not made public, and those rose up in the early 2000s because the big firms, the Fidelities of the world, started getting concerned that these high frequency traders and other computer firms were able to game their orders, their big whale orders, million share buys of IBM. When those went out and hit these lit markets, it was a bloodbath, because the prices would just run ahead of them, and the funds would end up buying for a higher price or selling for a lower price. So a couple of places opened up these dark pools as a refuge, essentially, for the institutional firms, and that's what it was.
Essentially, a response to the islands of the world.
Yeah. Island was, the most lit exchange there was at the time. You could even say that the floor of the New York Stock Exchange was a dark pool, because the buying and the selling that took place on the floor wasn't public. It wasn't available for everyday investors. But as the computer firms moved in, and in Island, and there were other firms like Archipelago that were doing trading, executing share trades just like Island was. Archipelago was also getting bigger. It was too much out in the open for these firms. So, to enjoy the advantages of electronic matching of orders, but do it in a place that is far more opaque than the new lit systems like Island, the dark pools started rising up. So in a way, they were a symptom of something that was happening that was changing the market.
So, what year are we roughly hitting? I know you were establishing the Instinet Island combination, but what year are we roughly hitting as this is starting to unfold?
This is the early 2000s, so 2002, 2003. I think LiquidNet, which was one of the first big dark pools, I think that was founded in 2000. But they were all really tiny in the early 2000s. They weren't getting a lot of orders. It took a while for these dark pools to really catch on.
Well, how did this affect for the audience to understand? Okay, I think everyone can follow the logic of how Island was moving forward. And then the kind of a response, or as you say, symptom with the dark pools unfolding. What was the response of the Island type thinkers, those kinds of guys out there, because now they can't do what they were doing, right? I mean, the HFT guys that were coming to Island's offices, they were saying, well, this is great. We can move faster. We can see what these big mutual funds are doing. Now with the dark pools, that's making it tougher, right?
Yeah, I think it...
Is that the right way to say it, though? Is that the right way to think about it?
Well, I think that's what the dark pool firms wanted to do. They wanted to make it tougher. But, it was really challenging because, market making requires some visibility into what's going on in the market. And these dark pools are essentially saying, just send us your order and float it in here into the dark, and you're not going to know what else is going on there. And if there's a match, you'll match up with this other firm, and your order will be executed. And I think it took a while for the institutional firms of the world to really see the advantage of that, because it seemed
seems like there's a lot of trust involved in that. It seems like.
Yeah, and there's been, ever since this started happening, concerns about gaming going on inside these things. They are totally opaque. So it wasn't really a big deal to the islands of the world in the early 2000s. I think that they were just dominating. They were just growing bigger and bigger and bigger. The dark pools are sort of these tiny little operations that were, picking off orders along the edges, but not really threatening their business.
Well, when does that start to shift? Bring us up into a year when that starts to shift.
I think the real shift happened in 2005. That's when NASDAQ bought Island, essentially. Instinet had bought Island, or Island and Instinet merged, but really it was Island taking over Instinet. So the guys who were in charge of Island were now in charge of Instinet. In 2005, NASDAQ bought Island and essentially turned the NASDAQ's matching engine into Island. So now, today, what is running NASDAQ is Island, is this computer system that Josh Levine set up in the 1990s. That's what's behind it. At the same time, the New York Stock Exchange bought Archipelago, which had been the main competitor of Island. Archipelago had been formed in Chicago by this guy called Jerry Putnam, who I also write about in my book. And so now you've got these two big ECNs who are big competitors. They are now huge parts of the two biggest exchanges in the United States. Archipelago becomes the electronic arm of the New York Stock Exchange. So all of the high-frequency firms that had been operating on Island and Archipelago for all those years are now right in the middle of the United States stock market, and they are running the show. Now, if that's not bad enough.
Well, when you say that, though, just for the average person, when you say they're running the show, can you put some context with numbers there?
Yeah, well, it's hard to say exactly how much of a percent of trading at the time was controlled by high-frequency trading, but the best estimates I've seen around 2005 is about 30%, which is a huge chunk. Is this
necessarily a negative thing? You led in the beginning of this discussion, we're saying you didn't necessarily view it as a negative. Would at this point in time, would that 30% have been a big negative necessarily?
I don't really think so. It wasn't, there are a lot of debates about this. What's positive, what's negative. At the time, the change from the human-based system to the computer-based system had brought so many positive side effects that the negatives were really hidden. So the spreads were narrowing a lot, and you could say that's probably pretty good for average investors because it makes it cheaper to buy and sell a stock. Arguably, there's other sides to that argument, but the market seemed to become more efficient, and you also eliminated some of the games that had been playing by the specialists and by the market makers. So it seemed like putting machines in the middle of things, you were cutting out a lot of the the greed and the gamesmanship that had been going on and really had been. I mean, there were some really terrible things that had been happening. And so, as I say, I think that masked some of the negatives, and people didn't really see the negatives. But then it got bigger and bigger, and those negatives have become a lot more apparent.
So we see these combinations with the exchanges, these ventures to combine forces. And at the same point in time, where are we with the progression of dark pools at roughly the mid-2000s?
Mm-hmm. They're getting bigger by around 2005 because I think that when the institutional firms see that the exchanges are now incorporating computer trading, they're seeing their advantages go away. I mean, let's be honest, Fidelity, to get a pretty good deal with the specialists on the floor of the New York Stock Exchange, all the big firms, it was an insider's game. So they liked that, and that was going away. So to find a new place to trade, they started going to the dark pools, and it wasn't like it had been on the floor of the New York Stock Exchange with the specialists, where the Fidelity fund manager and trader, knew, just the night before, taking out the specialist running IBM to drinks and take him to a Yankees game. That whole thing was over. But the dark pools seemed to offer something that was at least somewhat safer than throwing your huge order into the middle of this pool of sharks who could just shred it alive. And so the amount of volume that the dark pools were accounting for by the mid-2000s started getting bigger and bigger. And within a few years after those mergers happened, they accounted for about 10% of all trading of U.S. stocks.
And just so I want a little further clarification on the dark pools for folks that are following along. And look, we're kind of doing the Cliff Notes version here, so you're gonna have to dig into Scott's book to get all the little details here and really follow the narrative tightly. I just want to make sure we get some big picture points here. But dark pools, are we completely unregulated?
They're not completely unregulated. So there is a regulation called Reg ATS, which is Reg Alternative Trading System, which dark pools fall under. But it's I guess what people call in the jargon of the industry lightly regulated. So the regulators don't really, they don't show up at the door of the dark pool and say, okay, let us look inside your computers and see what you're doing, and just to make sure that everything's on the up and up. Perfect example of that is one of the more popular dark pools called pipeline trading systems, which I've recently written fairly extensively about for the Wall Street Journal. This dark pool claimed that it was matching natural buyers and sellers, which means the one side of the trade would be maybe Fidelity and the other would be T. Rowe Price. So natural firms are meeting together and there's no middleman. What actually was happening was Pipeline had set up a secret middleman, which was established one floor above their office in Midtown Manhattan. And that secret trading operation, which was called Millstream, was looking at the orders that were coming in, and they could figure out, whether it was a buy or sell, and they would see what stock it was for, and they would go into the market, and if it was a buy, they would go up and get a whole bunch of stocks so they could sell to that order, and they would do the same thing for a sell order. So they were a secret middleman, and these were guys sitting there at their computers doing this. The regulators had no idea that it was going on for years, until a guy who had been a trader on Millstream went to the SEC in 2009 and blew the whistle on him. And now that whole thing has been shut down and Pipeline doesn't exist anymore. But that's an example of what happens with an industry that is lightly regulated, we'll say, but really not regulated at all.
Interesting. So let me ask this too. We've seen the great debate for credit default swaps in the last couple of years. And then we see the guys in Chicago and the futures exchange saying, hey, look, if it's all transparent, it's out in the open, there's some real benefits here. The Chicago exchanges have worked well for over 100 years. Obviously the banks, they having their tight little club, and they don't want to have everything as regulated as out there in a public exchange with lots of transparency. I guess in my mind, I'm starting to see some of that, kind of the dark pools almost versus CDS, where it's just kind of away from, it's the way for the big institutional players to do their thing without anyone checking in on them. Is that the right way to look at it for the individual out there?
Yeah, it's a benefit of operating in the shadows. It helps the institutions do what they do. If you're big, you get good deals. If you're not so big, maybe you don't get very good deals. And the derivatives industry is it's very interesting, and in ways you could compare it to what the stock market was like in the 90s when it was run by these human middlemen, and they had a virtual monopoly on the trading of these stocks at NASDAQ and the New York Stock Exchange. Now that's what we call J.P. Morgan or Goldman Sachs. They are the big brokers of massive amounts of derivatives, credit default swaps and interest rate swaps. And what the regulators are trying to do with Dodd-Frank is push the trading of a lot of that stuff into the open, so that the end users, the buyers, can actually see what the prices are on a public market. The industry, the J.P. Morgans of the world, hate that, because it's going to, what it will do is what happened to stocks in the early 2000s is the spreads will collapse because people will have a much better idea what the real price is, and it'll be much less profitable for those dealer firms. So it's been fought tooth and nail by the banks. It's still being fought out as the regulators are crafting their rules. But are there going to be negative side effects of that? Probably. We don't really know what they are right now, but you could see something similar happen to what happened in the stock market. The futures market is interesting too because it's completely different, but it is all run by computers, and you don't see some of the problems you see in stock markets.
Let me bring up an event where I think most people are they're gonna be glad to hear this, because I think you can give a perspective. People have heard the term, they know what happened that particular day. I remember watching the TV at the point in time during the flash crash, and it was like, it seemed like every time somebody in Greece got hit with a baton harder, the S&P would go down farther. And I was like calling my buddy who was running a fund manager. I was like, are you watching this? The more they hit the Greeks, the more the market's dropping. This is crazy. So let me let you take a step back though, and kind of set that up before it happened, and kind of walk through it in the context of some of the things that are in your book.
Right. I had my own personal experience with the flash crash. I actually, at the time, was covering Berkshire Hathaway for the Journal, and the weekend before that, I was covering Berkshire's annual meeting, which was in Omaha, and I'd been really wanting to meet this big dude in high-frequency trading called Dave Cummings. And I decided to drive out from Omaha to Kansas City to meet Dave. TradeBot, which is the high-frequency firm that he runs, is based in Kansas City. So I went out there and I met him, and we talked for a couple hours. And then this is early May 2010. I went back to the Journal a day later, and on May 6th, I was sitting there on the desk in the New York office of the Journal, and we started noticing the market just going down a lot. And this was around 2:30 that me and several other markets reporters started looking at the ticker for the stock market on somebody's computer screen. We're just standing there, and then it just started completely collapsing, and this one editor next to me started screaming because it was down 600 points, 700 points, 800 points, and it was just seemed like this, the whole thing is collapsing. So, at the time I had just written the Quants, and people looked at me and they said, "These are your guys, Scott. They must be behind this." We know that everybody knew the Greece thing had been going on, but there's also a lot of stuff going on in Europe, and I think people were worried that, oh God, it's Lehman all over again. So they told me to figure out what happened, and I kind of laughed. I was like, yeah, right. I'm just going to pick up the phone and find out what happened. But what I did was I had just met Dave Cummings at TradeBot. So I picked up the phone and I called Dave, and he answered the phone, and I said, "Hey Dave, I can't believe what happened in the market. What does this look like from your end?" And he was like, "Oh, it's crazy. We got out of the market. We had to stop trading because when the market gets wacky, that's what we do. We just get out." And I was like, "Oh, okay. You stopped trading. All right. Well, do you think that had any impact? Did anybody else do that?" And he's like, "I don't know." He was really flustered. So I got off the phone with Dave, and then I called a few other high-frequency firms that I knew, and they all told me that they had got out of the market because things had been too crazy. I also called a broker that I knew that had a lot of high-frequency firms that traded through them, and he said almost all their clients just shut down. around 2:30, 2:40 that afternoon. So I started writing up a story about how all the high-frequency firms pulled out of the market that afternoon, and that may have added to the volatility because, they are the market makers. And without them, there's no liquidity. So as much as people may hate them, they also need them. So, we wrote this story, it was in the paper the next day, and I think that kind of set the tone for the debate about high frequency from then on, because it was this, people realized that, yes, these guys provide liquidity to the market, but when things get really hairy, they pull out, and that's sort of like a fatal flaw in the market structure that we have now.
But it's funny, that's in my world, I write about trend following traders, one of the things that I do, and it's a basic trend following type strategy that when volatility expands, your position size decreases. This is like a basic precept that goes back to Jesse Livermore's time in the 20s and 30s. High volatility, decrease your size. So the HFT guys are just being smart at that stage of the game, right?
Yeah. I think that it's one of those things where, I think game theorists really have a ball with this, because they're operating to their own advantage by getting out of the market. And the idea is in a market, when people are operating in their advantage, that should make things better. But in this case, people operating to their own advantage by getting out makes things worse for everybody. So, yes, you cannot say, look at these guys and say, well, you should have stood there and let the Mack truck run over you. You cannot do that. They are going to do what that is real money on the line for them, because they like a little volatility, but when things are super volatile, it's exactly what you're saying. They reduce their position. They're doing that same old trend following style that the people who listen to your program do. They have some other unique twists on it, but it's very similar. They can just do it a lot faster and for very short periods of time than any human could do.
Let me ask you, so where does that leave us today? I know I can't keep you on the horn all day. It's fascinating to me, but where does that leave us in terms of where we are today? We've still, we've got the two large exchanges out there that everyone knows about. We've got dark pools out there. Why don't you bring us up to speed in 2012? How large have the dark pools, where have we moved to in their expansion?
The dark pools are now roughly 13 to 15% of volume. But this is what I was saying earlier, is my definition of dark pool is a little different than the traditional dark pool. I'm saying that the entire market has gone dark because no one knows what's going on in the market anymore, and I'm not saying that to be sensationalistic. I'm saying that after talking to everybody in the market, from the heads of the exchanges to the heads of the dark pools to the heads of the high frequency firms. I've talked to everybody all around the industry. I have a pretty good idea of what's going on and what people know. I've talked to people in the SEC and the CFTC. What I do now is cover regulations for the Journal of Financial Industry, and no one knows what the hell is going on. Okay?
What does that mean, though? Because they all. I mean, when you say they don't know what's going on, the HFT guys know that their bots are going to be buying and selling at predetermined algorithms.
Yeah, but they don't know what their competitor is doing. So a guy at GetGo,
it's the counterparty issue.
If you look at the order book of any exchange, you think you could deconstruct what's going on, but you can't, because the firm that is trading on NASDAQ is also trading on the New York Stock Exchange, or BATS, or Direct Edge, the two other exchanges, and dark pools, and on commodity markets, and they're trading in Singapore. They're trading all around the world. They're how that trading interacts with other markets it's become so complex, and the computer systems that are running these programs are so complex, and they're everywhere. And when you try to dig into the guts of a single exchange and look at how it works, and you see these various order types that they provide to clients, they are extremely complicated. And how those order types interact with other order types. And, this is something I write a lot about in the book, is what are these order types? Who do they help? Who do they benefit? And it's actually kind of disturbing, because it looks some of them have been designed specifically to help a certain kind of trading strategy, which is high-frequency trading. And I know the SEC right now is investigating that. We've written about that in the journal a couple of times. Have the exchanges, in order to get the flow of the high-frequency firms, given them an advantage over other firms by giving them these special order types. So, I think that it's just the evolution of trading and of the markets has advanced so rapidly that it has turned into something that nobody can understand. And maybe that's just inevitable.
You seem to, but when you make that statement, my first thought is, well, here's a gentleman yourself. You've probably done more research in this area than, there's probably not many peers that have dug into this as much as you have and talked to as many players. And as you say this, and I listen to the tone of your voice, I guess the conclusion I have to draw is that Flash Crash was inning number one, and there's plenty of innings left to come at some unpredictable point in time in the future.
Yeah, I think that's probably a pretty good bet. We're going to see stuff like that again, unfortunately. And this is why I'm making the argument that the regulators really need to step up and, let people know that they're really on top of this. And right now they're not.
I caught a headline, and I might be citing the numbers wrong, but I think it was Barney Frank asking a few questions of Jamie Dimon the other day, and it was to the effect of, do you think the current couple $100 million budget for the CFTC, I believe it was millions, is sufficient enough? And, Dimon was like, I don't know if it's sufficient or enough. And I remember back in the day when I was looking for information and going through the CFTC, it reminded me of the typical government office, which I haven't even seen at the local level, which is, these are not organized in a way to compete with the best and brightest corporate entrepreneurs that are out to make a dollar. It's just not, they can't compete, can they?
The answer is no.
Yeah.
Not at the budget level now. I think it's, $650 million a year. The SEC is, between $1 and $2 billion. The responsibilities of the SEC or the CFTC have risen dramatically in the last few years because of Dodd-Frank, because now they're tasked with overseeing this huge swaps market. So at the same time, their budget hasn't gone up. There are smart people at the CFTC and at the SEC, but not nearly enough. And they also need to dramatically improve their technology and their ability to surveil the markets. They don't have that now. They rely on the exchanges. I mean, all the regulation has been outsourced, and that's part of this whole deregulatory movement that happened in the 80s and 90s and into the 2000s. And the idea was the markets will regulate themselves. And I think it's nice in theory. I mean, I wish it worked all the time, but it doesn't always work. I think we've seen that over and over again recently. So you need a strong regulator to give people faith in the markets, because that's the real problem right now. Is we're seeing a huge crisis of confidence in markets, especially in the stock market, with something like the Facebook IPO flop, which came on the heels of the Bats IPO flop. People are realizing these things don't work all the time, and maybe it's rigged too. So, but who knows? That's the problem. It's because it's dark and opaque. No one really knows, and nobody can give you an answer. Mary Shapiro, the chairman of the SEC, can't come out and tell people, "No, we know everything's cool. We've got it under control." No one will believe her. And she's told Congress she doesn't have the ability to surveil the stock market. So, that's a huge problem. It's like saying, on the highway, the speed limit is 65 miles an hour. Oh, by the way, we don't have any cops.
It's amazing to hear you say it, is because I feel like in my world, I've had a chance to get behind the scenes, wrap my arms around, talk to a zillion different players, really understand trend following managed futures space. It's there. If you want to understand it, it's there. And to listen to you, you've done all this research, all this homework, spanning back, digging into a decade's plus worth of time and players, et cetera. And you're saying very honestly, I don't know. And I think that's got to cause some people to kind of go, wow.
Yeah, well, I mean, it's the truth. I don't think there's any question about it. You know, the futures market is a little bit different from the stock market, though. So the futures market is largely controlled by a single dominant exchange, the CME, Chicago Mercantile Exchange, and you don't have the fragmented market with dozens of different venues and dark pools and as you have in the stock market. And my book is almost entirely about the stock market. I think the futures market is a lot healthier. That's not to say that there aren't games going on in the futures market, because I've talked to guys at some big hedge funds and told me that they see really weird stuff happen sometimes in their markets on like oils futures or other commodity futures. So there are games going on there too, but I don't think it's at the same level as you see in the stock market, which is just totally fragmented, and the New York Stock Exchange is a dying entity. I was just on the floor of it a week ago on CNBC, and I couldn't believe how quiet it was on the floor at the Open, because it used to be crazy at the Open.
I saw your comment on that on CNBC, and it didn't look like anybody was happy, because you said something to the effect of like, it seems like a stage set for you guys. There's nothing going on here. They were all kind of like, what?
Yeah, I know. I mean, I didn't come on with planning to say that, but I was just shocked that as I was standing there waiting to come on, because it was in the morning right after the Open, I saw the bell ring, and then everybody just stood there and started chatting, and it used to be this hive of energy, and I was just shocked. And I mean, and I've been researching this for years, so I hadn't been on the floor for a couple of years. I used to cover the exchanges for the Journal, and so I'd been there a lot. So I was really just kind of surprised, and they're kind of like, you need to get out of here after you're done. So they did kind of shuffle me out of there really fast.
I was like, Scott's making friends with everybody on the floor today.
Yeah. Well, the thing is, like, I'm not anti-floor. I'm kind of lamenting the death of it. It's kind of inevitable that it's a great American institution, and it's being phased out. And it is a studio set. I mean, let's be honest. I've talked to the executives at the New York Stock Exchange. They as much admit it. It's a PR piece for them. It lets them, get their name out there. They could eliminate it, and nothing would change.
But I bet the average person doesn't know that. The average person probably still sees the excitement on the screen in their living room, and they probably think there's all this stuff going on there, and you've just laid out over the last 45, 50 minutes, you've laid out, no, it's not taking place there. It's taking place inside computers, racks and racks of computers co-located next to exchange servers, and there's all kinds of stuff going on that you can just never understand, written at a computational code level, right? I mean, it's data centers in the countryside of New Jersey. That's where our modern-day stock market is. I actually went out to the New York Stock Exchange's data center in Mahwah, New Jersey, when it was being built, and wrote an article about it for the New York Stock or for the Wall Street Journal. So it had all these wires dangling out of the ceilings and everything. It was really surreal, because I was, it's the thing, this massive size of 3 football fields, and this gigantic building, and I'm walking around, and it's just a bunch of concrete and tubes and wires and stuff. And I was thinking, like, in a year, this thing's going to be full of servers, and there's going to be billions of dollars moving through this thing, and it was just, kind of dreamlike. And now that is the New York Stock Exchange. I mean, that's what a guy there, a technologist for the NYC, told me as we were walking out of that building. He said, "This is the new floor." So I'm not exaggerating this stuff. Yeah, people don't know.
it's happened so fast. And I've, talked to people, family members and friends, and tell them, stuff. They've read some of my book and they're like, oh my God, I had no idea that this had happened.
Let me ask you, I'll leave one more question. I don't think we've given away the thrust of the book, in terms of, but your subtitle, "And the Threat to the Global Financial System." And I brought up the idea of another flash crash type situation. What is, for the average person out there, when they really want to get some education and be up to speed with things, what is the ultimate threat to the global financial system via all of these insights that you've pulled together in this new book?
Right. Well, it's how all these markets have come together. Now, a firm trades not only in the stock market, but on the futures market, or in currencies and bonds, and they're trading them all together, and they're trading one against one another all around the world. So a concern and a real possibility that very smart people have floated out there, and this isn't something that I'm making up at all. Some people have called it splash crash. And this is where you see some systemic event happen in one asset class, and it could be because of a fundamental reason. Say something really insane happens in Europe, and Greece just comes out of nowhere and says we're pulling out of the euro, and bam, the currency markets go haywire. And yes, there is a lot of computer trading going on in currency markets now, massive amounts of computer trading. So, computer goes haywire because all of a sudden all the correlations go out of whack, and movements are too fast, and strange things happen, and you see some really big move. So you have another part of the computer program, and all of these guys are looking at very similar things, sees that big move, and that says signal futures sell. So the futures market starts going down in tandem. The futures market gives a signal to the stock market, and that gives a signal to the bond market, and it just splashes from one asset class to the next. And in a matter of minutes, you see this gigantic move that sweeps through global markets that is a systemically shocking event and impacts economies, and not really because of a fundamental reason, even though maybe there was something fundamental behind it, but nothing remotely close to what you see happening because of the ripple effects in computer trading across all these asset classes. So it's a very scary scenario, but a very, very real possibility as this industry gets bigger and bigger and more trading happens on computers.
Well, I guess we're just going to have to keep our fingers crossed and pray like the Y2K fears nothing ever materializes.
Yeah, but Y2K was a one-time event. This is happening every day, so the odds of it happening are.
I was trying to be optimistic.
Yeah, I know, but I don't get a kick out of this, and I would love not to be able to say it. But I really think that raising that concern, say it's a 1% possibility or 0.5% possibility. That's enough for people to really, start thinking about it and looking at how it could be stopped. And the regulators the CFTC is looking at kill switches that can be implemented on futures markets if something really big happens. The SEC's implemented circuit breakers on the stock market to short circuit a big move like that, and maybe more things like that could keep something systemic from that like that from happening.
Well, I'm going to implore everybody to take a peek at your book. It's called Dark Pools, High-Speed Traders, AI Bandits, and the Threat to the Global Financial System. Scott Patterson is the author. Scott, I appreciate you being on today, and I think everyone's going to find this really informative. I know I did. It felt like Professor Patterson teaching me about something that I was not familiar with, so I appreciate it.
Thanks a lot for having me, Michael.
Take care.
I see a time when those awake will understand how to make money in up, down, and surprise markets. Whether new trader or experienced, college student or financial advisor, protecting against a crash, or just trying to make a lot of money. Trend following offers everyone an answer in uncertain times. To get started immediately, send me an email, michael@covel.com. I will send you the right trend following steps to take along with my free video. But if you want to buy and hold, trust the government and trust Wall Street, this is absolutely not for you.